You're listening to the House Hacking Podcast, the blueprint for one of the best financial life hacks there is. House hacking. If you are looking to get ahead financially or learn about the easiest way to get started with real estate investing, then you are in the right place. Stay tuned and join a community of individuals from all walks of life that use house hacking to eliminate their housing costs and accelerating their path to financial independence. Your number one place for all things house hacking.
Amanda, thank you so much for being on the show with us. I mean, ever since I read your books and then also, knew about you and started my podcast, I've been wanting to have you on, but we used our sort of first two seasons to set the stage about house hacking. And now here we are, third season, doing a deep dive into working with the CPA and tax advantages in real estate. So thank you for calling on. I'm getting way ahead of myself. How are you doing and where are you calling in from?
Yeah, thank you so much, Andrew. I'm so excited to be here. I am calling in from Southern California, and things are going well here. I'm really excited to be on this podcast and talk about all the tax strategies specific to house hacking.
Great. Yeah, I know. I'm really pumped about this show. So, man, there's so many different places to start. I want to try to keep this show moving sort of maybe in this natural path of like, instead of diving right into a tax strategy, maybe we take a step back and say, what are the actual benefits of using a CPA? Like why should someone say, I just use TurboTax and I'm buying a property now to house hack, and why don't I just keep doing that versus using a CPA?
Yeah. Well, I mean, not everyone has to use a CPA, but when it comes to real estate investing, whether it's house hacking or buying other rental properties, the tax code is filled with loopholes and benefits for investors specifically. So, if your day job is not a CPA like myself, then generally you're going to get a lot more value when you work with someone who specializes in real estate, because it's difficult. You might be reading blogs or even listening to this podcast, but you'll see that there's still a lot of intricacies within every transaction. So, the way I look at it is, for me, as an example, I'm not good at everything I do. And the things that I'm not good at, I want to leverage the knowledge of an expert. So, for if someone's an investor and tax is not their strong suit or they don't have experience in it, certainly is something that, you want to leverage. You don't want your CPA or, you don't want your CPA to even be like your sister who's doing tax returns in the basement or something like that, right?
Absolutely. And for me, I think I was already on my second house hack, and I think I was up to 2 or 3 properties at that point. And that's when I sort of switched over to a CPA. I was very nervous about it. I didn't want to spend the money, especially in the more frugal personal finance, early retirement community. That I always have this saying, and someone else made it up. It's like, don't trip over dollars to pick up pennies. And that's exactly what I was doing. And as soon as I went to the CPA, I was like, oh, I didn't know I could do that. Didn't know I could do that. And what I spent, she easily saved me a multiple of that.
Yeah, I do hear that a lot. And it is kind of scary for people. Let's face it, right? Taxes is scary by itself. People don't like talking about it. People don't like paying it. We sort of avoid it like the plague. But especially for real estate investors, it's a huge opportunity area to really try to use real estate and reduce our taxes legally. So I would say, face the fear. And if you're working with the right CPA, the goal is, that you're saving multiple times what you're paying them in terms of fees, right?
Yep. So Amanda, you and I haven't worked together, but I just want to give a little shout out to like CPAs in general. And I'm writing a blog post on this, and I'm hoping I'll have it done. Maybe I'll make this a goal for when this episode comes out, but it's essentially on my 29 tax return through using a good CPA, doing some advanced planning, and sort of doing some strategic tax savings. We are able to have, my wife and I, essentially a 1% effective tax rate. So on a 6-figure income, our check to the IRS this past year was like $400. So pretty cheap, all things considered, but the CPA helped me do that. We also had like we did a cost segmentation study for some of our properties and pulled forward some depreciation. a lot of good write-offs, deductions in there, but benefits of the CPA, like you said, are vast. All right, so we're now convinced we need to use the CPA. What should we look for? Obviously, I think the first call should be, let's call Amanda and use her strategic tax savings program and get her to help us. But, maybe someone's saying like, I'd prefer to work with something local.
Yeah.
What should we actually look for in a CPA?
Certainly, certainly. And that's, the main thing that you want to look for in a CPA is someone who understands real estate, right? Because real estate is going to be one of your main wealth building asset classes. So it's very important that you work with someone who is well versed in real estate. I think that's first and foremost. The tax code is super complicated, and you don't want to work with someone who's kind of a jack of all trades. Where, oh yeah, I'll take you if you have online sales and you do real estate and you're, also have a manufacturing or a restaurant business. That's a disservice because, for us, even though we specialize in real estate, there's always updates, there's always new changes, and we're always constantly having to educate and re-educate ourselves. So that's the main thing you're looking for. And a good test to go through is, when you're talking to a CPA, ask them, house hack, I'm doing house hacking. What's their reaction? Do they know what you're talking about? Is that super confusing to them? When you use a lot of these like real estate terms. And another question to ask too is, what are you seeing other clients, other real estate clients of yours do that's successful, right? And we want to see, okay, how many real estate clients do they have? You certainly don't want to be their, one or only handful of real estate. So I think whether it's someone local to you or in a different state, that's a very personal decision. Like you said, some people really want to be sitting down face to face and, really close by. Other people are okay with, Zoom and conference calls. But the main key is someone well-versed in real estate, and you don't have to explain what is cost segregation, what is depreciation, right?
Yeah. And you're in trouble if you are having to explain that to them. So should they have any sort of designation, or is there a difference between someone says, hey, they're a tax preparer and I've prepared taxes for a couple other folks that have done real estate? Is there any qualifications we should be looking for as well?
Yeah. And first I would say, let's shy away from people who say I've done a couple clients in real estate, because that could just be, I have 500 clients and 2 of them's done real estate, in which you're still going to be one of the guinea pigs. So you want, a pretty substantial part of their business to be real estate investors. And with respect to designations, being a certified public accountant, which is the CPA, obviously is very good because they've gone through the education requirements, they've passed the testing, and they continue to receive continuing education. What a lot of people don't know is anybody can be a tax preparer. Anyone can sign tax returns. So a lot of times if you go to places like, maybe like an H&R Block or something, that person could have no accounting background at all and could sign a tax return. So some sort of designation. CPA, of course, is really great. Also look for an enrolled agent. They don't go through the process as rigorous as CPAs, but they do go through a process with the IRS to get some sort of credentials. I think those are the 2 I would be looking for, and not just, quote unquote tax preparer.
Awesome. Wonderful tips. Thank you. All right. So, we realized we need to use a CPA. We found a great CPA with real estate experience. They're actually an accountant, not a tax preparer. So, what do we need to keep track of throughout the year to make it easier for our CPA? And then do you have any sort of tips on, best practices or systems for how we should track stuff throughout the year?
Yeah, I love that question. I think you're one of the few people who've even asked me that. A lot of people don't ask me that question, and it's so good because
my accountant loves me. Let me just say, she's like, your returns are huge. They take a long time, but you're so organized.
Yes, that's so good because, and it's the connection is this, right? Even if you find the best CPA, the expert in real estate, it's not going to help you if you're not organized, right? Because for me, even, if you say, oh, I'm working with Amanda, I know she knows all her taxes about real estate, but if you come to me with nothing, there's not a way I can help you. What did you spend money on last year for cars or your home office? So, for your role as an investor, the key thing is to make sure, what do I need to track? how do I stay organized? And I love that you brought up systems. I'm a huge systems person. I think everything that gets systematized gets done and get done correctly and efficiently. There are people who, the kind of system you use though is really dependent upon you. So, if you are good with computer, technology, you can use QuickBooks, or, there's Google Docs and all kinds of receipt scanning. So whatever system works for you is what I would recommend. Sometimes clients will say, what do you prefer? Do you want Excel? Do you want QuickBooks? And I just let them know it's what you prefer as the investor, because I might like QuickBooks, but if you're not really interested in using that technology, then I don't want you to use it, because what's going to end up happening is you buy the QuickBooks and then you don't want to touch it because you're afraid and you don't want to learn it. So it could be Excel, Google Sheets, QuickBooks, or even I have clients who still do the, old school pencil and paper. But the key is to have a system in place so you know what's tax deductible and you have a way to track those throughout the year. Because, if you're like me, I can barely remember what I had for breakfast 3 days ago. It will be impossible for me to remember what I did 6 months ago, right? If I'm looking at tax return stuff. So the more, real time you can do your record keeping, the better it is, because you won't be forgetting expenses that you've spent money on recently.
Great. All right. So say we've got a house hacker, they're living in their duplex, and the tenant calls and say, hey, this thing's broken over here. They go to Home Depot, buy $100 worth of stuff. They do the work. Can they just enter that receipt and say, okay, great. I'm using QuickBooks or whatever their system is, and log, I spent $100 at Home Depot, and then throw out the receipt? Or should they save the receipt? Or what? Just talk us through a little bit about what documentation do we actually need to save, and for how long?
Yeah, that's a great question. So I would say the way we look at it, receipt is kind of your insurance policy, right? Some people say, well, clearly you can see at on my credit card statement or bank statement that $100 was taken out for Home Depot. But what you can't see in that credit card statement is, what did you buy at Home Depot? Maybe you bought a Christmas tree for your own house, right? They can't tell what you bought unless you have that receipt. So yes, my recommendation is always to save the receipt. Now, it doesn't have to be that little piece of paper. It could be you take a picture of it, scan it, put it in a Dropbox. You never have to look at it again, right? As long as you've recorded it, and your CPA is going to have it at tax time, the receipt itself is really going to be looked at again if you get audited and if they question that specific transaction. But yes, we highly recommend that all receipts are kept. Now, how long should you keep them? It's going to depend. For regular expenses like what you're talking about, generally you want to keep it at least 3 years from the date you file your tax return. So if I file the tax return today, for last year, I want to keep it 3 years from today. There are things that we want to keep longer than 3 years with respect to real estate specifically, which would be like the closing disclosures, loan documents, house hacking specifically. If we have a primary home, we're doing a lot of improvements to it. Sometimes people don't keep those receipts because they think, well, it's just my primary home. But we'll talk about a little bit later, if your home is also a house hack, some of that could be deductible. So those are things you want to keep maybe for a little bit longer if they're indeed major improvements to your property.
Awesome. All right. So we're starting to track stuff properly. What are some of the, like, a top 3, top 5? What are some big things that folks tend to not track or not realize they can write off? Obviously most folks would think, oh, I went to Home Depot or Lowe's to buy supplies, or my HVAC went out and I had to have a contractor come out and I wrote him a $500 check. Most folks think that's a write-off. I can save that because it's a repair on the rental portion. So outside of that, what are some things that most folks usually forget about or don't realize they can use as a write-off?
Yeah, so that's a great question too. Most people are really good at all these things you named are what we consider direct expenses. They're directly related to the property. But there are also a lot of overhead expenses that we have as real estate investors. And those are the ones that people lose out a lot or miss out a lot. So examples might be, maybe I bought a book, a tax strategies book for real estate investors, right?
Maybe this tax strategy book right maybe, here.
Yes, my shameless plug.
Or this other one right over here. Remember, we're going to do the giveaway in a little bit. So we got a couple copies of her books.
So maybe you're spending money to buy books. It's not related to my property on Main Street, but I'm certainly, the reason I'm buying it is because I'm a real estate investor. It helps with my real estate. So things like that, or, accounting fees, legal fees, some major ones that almost everybody has, car expenses, right? I'm driving my car, some, to the property or even not to the property. Maybe I'm driving to a local real estate meetup, or I'm driving to a conference or looking at open houses. It's not specific to a property, but they're still incurred because I'm a real estate investor. So yeah, car expenses, home office, another big one. I see you're probably, working out of a home office or
Yep.
studio. Most investors I know don't go out and rent a space just to manage their rentals. It's mostly going to be done from a home office. So that's another one too, a lot of people miss out on, because again, it's not directly connected to a specific property. They tend to not think about it or just are unsure whether it could be tax deductible.
Yeah, those are really great. So, I love the fact that you brought up mileage, because when folks are doing house hacks, they forget about that. It's like, well, I'm not actually driving to the property because
I'm
I'm
here.
living in the property, but it's, well, I'm going to go drive to the local real estate meet up, or I'm driving to the Home Depot, or I've got the business PO box and I got to go check that. Like, logging all that mileage is really, really great, and can help save you a lot of bit of money. Um,
Exactly.
so one of the things, you got your home office. If I'm deducting the space, can I also write off my internet or my cell phone if I'm a house hacker?
Yeah, and so home office is interesting too, right? So yes, as a house hacker, let's say you have 3 bedrooms in our example. One is your room, one is your office, and then the other one you've rented it out. So there's 2 different deductions we're talking about, right? The room that's being rented out, that's a rental, that's rental related expenses. We deduct things associated with that. But then on your home office, we claim that separately as another deduction for the rental business side of things. And yes, from a calculations perspective for the home office, we can deduct a portion of the household, utilities, internet, cleaning fees, security, and all those good things.
Awesome. Awesome. So all things to help us save money. All right. So let's get on to our community questions. Thank you for everyone that went into our brand new house hacking forums. Little shameless plug there,
Yay!
in putting questions, and for folks that responded to our Instagram stories. So let's get into these. I think we actually had probably 30 plus questions, and we
Oh,
sort of
good.
lumped them all together because a lot of them essentially went in the same vein. So we've got,
Okay.
what do we got? Eight, 9 questions here. And I think that when I consolidated all 30 down, they sort of all fell into this area. So, all
Okay,
right,
good.
first question from our community is, how should I strategize about making repairs and improvements to the owner occupied unit? So, I took this and I looked at this person's profile. They actually have a small multifamily property, a duplex. They're
Mhm.
living in one side and they're renting out the other, and they know they're going to move out of the side that they're living in. And they were wondering, well, should I go ahead and, upgrade the bathroom now so I can enjoy it? And then do I miss out on that future write-off? Or if I'm doing it when, the tenant's there, is it classified different? And maybe one other piece in here, if we could touch on, is there a difference between a repair and an upgrade from a tax perspective?
Yeah, great question. So, um, depends. So in this particular person scenario, in the duplex that they're in, the unit they're living in the duplex, let's say they decided they're going to live there for a while before they move out, right? Maybe they want to enjoy this brand new bathroom. So the good news is, no, you don't lose out on the deduction. If I'm going to spend 10, 15,000 to rehab my bathroom today, I'll live in here, then I'll move out and turn it into a rental a year or 2 years from now. That's okay, because the money we've spent on that remodel goes into our cost basis for the property. So eventually when we turn to a rental, we do get to depreciate it. Okay, so it's not gone. And it's good because you get to enjoy a new bathroom before
Yeah.
you move out. Now, on the other hand, if it's a situation where, maybe I don't really care about using a new bathroom, I just want to maximize my deduction the best that I can, then what we would likely recommend is that you do the remodel after you move out. And the reason for that is if you do the remodel and then you place into service as a rental in that same particular year, there are things we can look at for bonus depreciation and, maybe partial cost segregation to try to accelerate as much of that deduction as possible into that particular year. So, kind of the goal of the investor too, in terms of personal enjoyment versus strictly looking at write-offs, can yield a slightly different answer. When it comes to repairs versus improvements, that's such a great question. That's one that's, unfortunately is not an easy way for the IRS to answer. They've tried over the years. It's still super confusing for people. The way I would look at it is, if you're doing a whole project, for example, remodeling a whole bathroom, that's generally going to be an improvement. Versus if my toilet is broken or the faucet's broken, those are generally going to be repairs that I'm just fixing something broken. The main difference from a tax side, of course, is when it's a repair, you write it off immediately versus if it's an improvement, we have to depreciate. Now, having said that, it does not mean because I redid a whole bathroom, this is terrible and I have to wait forever to write it off. There's a strategy around that is if I'm going to spend $15,000 to remodel my bathroom, instead of just telling your CPA, hey, I spent $15,000 for the bathroom, if you do that, there's not much they can do to help you. But instead, if you tell them, hey, I remodeled my bathroom for $15,000, of which it was $3,000 for $3,000 for the vanity, $1,000 for the sink, $1,000 for the toilet, and I put in a new system in there. So with those different components, then your CPA can look at ways to accelerate some of those components, kind of like a cost segregation. So you can write off more faster.
And this is why it's important to save that Home Depot receipt, because if you just said, oh, it was X at Home Depot, you can't break that down. And this is why, as a real estate investor, if you're house hacking, and even if you don't ever want to go to invest in more properties, really document well what you do. That way, when you have a really good CPA like Amanda, they can help you look through all of these options and help you save more money. But if you're not tracking it and you're not documenting it really well what you're doing, you're going to end up costing yourself some money. And I'd rather not have you pay the taxes. I'd rather you keep it and then put it into another property, help improve a community, be able to pay off your debt. So really, really glad you brought that up. All right. So this is an interesting one, not quite tax related, but with your level of experience, Amanda, the person wanted to know, what do you wish you knew now that you knew when you got started?
What do I wish I knew when I first got, what I know now? Well, it's not, I'm actually the third generation of real estate investors in my family. So my grandparents were real estate investors. My parents invested in real estate. But they really taught me just the traditional route, which is, get good grades, get a good job, get into a college and then get a good job, and not really anything about building income, building cash flow, none of that. So it's strange. I think a lot of people read the book Rich Dad, Poor Dad. So I feel like I had the rich dad and the poor dad, and it was one person. but I was raised in the poor dad mentality. So for me, I didn't start out real estate. I didn't start investing in real estate until I think I was in my late 20s. So that's something I wish I would have known earlier. I think with the family background I had, I really wish someone in my family would have told me, to invest in real estate and have that be a wealth building. So yeah, I just, for people who are maybe new or newer to real estate, the sooner you get started, the better it is. And even for me, I remember for my husband and I, our first deal, we were so scared signing on the paperwork. My heart was beating out of my chest. Trying to figure out, is this the right thing? Do I really want to invest in real estate? And we kind of did a little bit of house hack too. We bought a rental, but for our own rental, for our own primary home, after we moved out, we actually turned it into a rental property, and it worked really well for us for multiple years. So I guess I'm part of the House Hackers Club too, now that I'm talking to you. I didn't realize I was.
Awesome. All right. So question number 3 from our community: are there advantages and disadvantages of using an LLC with a house hack? One thing before you chime in here, I want to mention about is one of the advantages of being a house hacker is you're buying your primary residence. So you can use low down payment loans like an FHA loan, the VA loan, the USDA rural loan, the NACA affordable housing loan, where if you're buying it in the LLC, it is now a true investment property and you're going to have to put down that 20 or 25%. So even if there are some great tax advantages, you want to weigh those out with the different loan options that all of a sudden you lose. So I'll shut up now because this show's about hearing great advice from you. So what are your thoughts? Are there any advantages or disadvantages of using an LLC for a house hack?
Yeah, not all. I love that the loan comment you make is certainly true, and we've had clients get tripped up by that. And so the good news is, from a tax perspective, no, there's not a need to have a legal entity in order to get the tax savings. So all the things we talked about earlier, home office, travel, car expenses, meals, business meals, of course, are all tax deductible, whether you hold your properties personally or in an LLC. So really, the only reason to have an LLC is for asset protection. Of course, so that's something for an attorney to comment on. But even if you do decide to put your primary residence / house hack in an LLC, we have to be very careful in that we want it to be an LLC that is essentially a disregarded entity, which means the LLC is owned by you or it's owned just with you and your spouse or through your living trust. Essentially, we don't want that LLC to be one that files a separate tax return. And the reason for that is, and one of the major benefits of house hacking is if you live in the house for at least 2 years, you get to exclude up to, 250,000 or 500,000 of the gain tax free. That is only available if the home is owned in an entity, is owned personally, or in an entity that does not file a separate tax return. So if for some reason you decide to put your house hack into an LLC owned by you and your friend, now the issue becomes, now it's owned by a partnership. You can't, odds are you're not going to get the benefit of the primary home exclusion. So okay to put an LLC, but make sure you talk to your tax advisor that it's still disregarded entity.
I know if you're trying to do like a value add or a property that needs a lot of work, or use like the BRRRR strategy with your house hack and you put it in that LLC with a partnership, you could lose out on that tax-free gain. So I think that's a great segue into this next question of, how does the 250, 500 tax-free benefit work, or does it change at all if you're doing a house hack?
Good question. So essentially, the benefit from the government is if you buy a house and that's your primary home and you live in there for at least 2 out of the most recent 5 years, then you can exclude up to 250,000 of gain tax-free if you're single, or if you're a married couple, the first 500,000 of gain is tax-free. So that's a great benefit that they offer you. And so what we see happen sometimes if, like in my situation, I lived in the home for X number of years, I moved out, I wasn't ready to sell it yet. You can actually keep that property and turn it into a full rental. And you can do that for another 3 years and still be eligible for that $500,000, up to $500,000 of gain tax-free. Now that is a key cutoff date, because if you move out and turn to a rental after that 3-year mark, you essentially lose out on that 500,000 gain. So for people who are house hacking and moving in and out of homes, you do want to make sure you have a detailed clock or calendar. So something pops up and you say, hey, I'm almost 6 months to the anniversary. Let's look at if we want to sell and do a 1031, or maybe we just cash out because we don't have to pay any taxes on the transaction. So yeah, it doesn't really change with respect to a house hack. I mean, if it's going to be when it's my primary home, I'm renting out a couple rooms, I still get the 500,000 gain exclusion. I don't have to prorate anything. Now, if, I'm assuming during the years when they're a rental, I have claimed depreciation, right, on the property. To the extent I have claimed some depreciation, that does get recaptured. So if I have gain, there are going to be taxes paid on that. But still, I always want to get a deduction today, rather, and then pay taxes later rather than paying taxes today. Right? If it's going to be like a duplex situation where I live in one unit and then the other unit is a rental property, you still get the capital gains. It's just going to be prorated because one of the, structurally part of it is a distinct rental and part of it is your primary home. But yeah, in either case, they're still, better than the alternative, which is not house hacking, right? It's all just going to be capital gain.
Yep. So you sort of started to touch on it, but one of the other questions from our community was clarification on the 2 out of the 5 rule. So over a 5-year period, they have to live in it for 2 years. And now, do you have to put the house on the market before the end of the 5 years, or does it technically have to sell and the whole transaction be finished before the end of the 5-year period?
Yeah, that's a great question. So it has to be sold, okay, closing the sale. So meaning if I moved out today, I have 3 years from today to dispose of the property if I wanted to. And I could still get all the up to 250 or 500,000 of gain. So that's why I was saying, it's good to monitor that on your calendar. So you have an idea, maybe 6 months ahead of time, look at the market, what's going on. Is there better, other places that I want to invest in?
Great. So the next question is right in the same vein, is asking for clarification on the capital gains rule. So they said there's a lot of confusion of some people think you have to live in a property for 2 years and think it's part of the 2 out of the 5-year rule. Or is it only like if you sell a stock, if it's less than 12 months, it's ordinary income, or if it's 12 months in a day, it counts as a capital gains tax rate?
Oh, good question. So, I mean, with respect to the 250 or 500,000 tax-free gain, that is a 2-year mark. So, 2 entire years of living there as a primary home. So that's different than the stock, which is 365 days. So yeah, so that fortunately, it is 2 years and not 12 months time frame. There are exceptions though, like if you had to move before your 2-year mark is up. There are times when you can prorate so that you still get part of your gain to be tax free. So some of the reasons for allowing for a partial gain, that's if you don't meet that 2-year mark, would be if there's some sort of unforeseen circumstance. So common examples which we hope we don't see, would be death. If people had to move because of death, divorce. Again, hopefully that doesn't happen, but those are times where you can move without meeting those requirements and still get part of that tax benefit. But they also, have some happier occasions like job change. If you had to have a new job and I think the mileage is about 15 miles apart, then you're moving to be closer to your job, then that is something that could be allow for partially tax-free. And then also another one they allow for is multiple births that are unexpected. So, maybe you had twins or triplets and now we don't fit in this house anymore. And then the other one is also for healthcare. If you have to move because of healthcare issues and things like that, there's also prorations. But outside of that, yes, strictly it's a 2-year. Make sure you live there for 2 years, ideally.
This is why it's important to have a really good CPA, because you can, when these things come up, you've got that trusted advisor to turn to that will say, oh no, there's actually this, where if you're just doing the normal TurboTax H&R Block form on your own, that doesn't always come up in there. So really great stuff. One other sort of piggyback on that someone actually had was, if you're, how does depreciation work with a house hack? And I guess we could give a couple different examples here. So if someone's doing that room rental style house hack, a 3-bedroom home, they're living in one room, they're renting the 2 others. The comment they made was, well, it seemed like I'd be able to write the depreciation off, but I wasn't sure because a duplex, half the property is rented, half's not. But when you have those shared spaces, how does depreciation work in that scenario?
Yeah, that's a great question. So, in that scenario, let's say we have 3 rooms and, in my house and I rent out 2 of the rooms. Typically what we do is we look at a square footage to figure out how much of the building basis is depreciable. So, if it's one, let's say 25% or 30% based on square footage wise, that's normally the number we do. So we take the building, multiply it by 25, 30%, and then that's the amount that we look at for depreciation calculation.
Great. And then what about in a scenario with a small multifamily property? Sort of same thing where if there's a clear division between, 2 units or 3 units, you're doing the percentage off of whatever those
Right.
2 units take up.
Yeah, exactly. So, I mean, in the simple example, we'll think that, if it's like a fourplex and, they're all the same two bed, one bath or same square footage. And, generally we'll just say, okay, well, I live in one. So 3/4 of that is going to be depreciable. 1/4 of that is my personal home. So, not going to be included in the depreciation calculation. So, generally just looking at a reasonable way to allocate what's the business or rental portion versus what the personal portion is.
Awesome. All right. So the last sort of big question that was from the community, and several people had a very similar question, is there a difference that we as a house hacker would pay on rental income if it's a short-term rental or a more traditional longer-term rental? So if someone's staying 3 nights and we're renting out on our spare room or our other unit in our multifamily, is that income taxed differently than if we have a traditional long-term lease?
Yeah, that's a great question. So, the big picture, the way I look at it is it depends on what type of services you're offering for the rental. Okay, so if it's a situation where I have a room that's available and some, Airbnb, they can come, they stay here for X number of days, and when they leave, I'll go in and I'll change the sheets before the next people come in. I'm not offering any kind of cooking, meals or anything like that for them. Generally, those are taxed exactly the same way as long-term rental properties, in that we don't have to pay self-employment taxes on. Okay. On the other hand, if it's more like like a bed and breakfast, if you will, right? I have my room, you come, I take care of you, come downstairs for breakfast, lunch, and dinner. That's more going to be treated as more of like a Schedule C active business, or what we call the hotel business, right? Airbnb hotel is where you're doing more than renting. You're effectively it's like hospitality kind of stuff. And so the difference is then if you're offering those kinds of services, is more going to be subject to self-employment taxes. So maybe not as ideal if it's going to be a profitable transaction in the coming future. But yeah, I would say just we have a lot of clients in the short-term rental space arena, whether it's house hack or not, and I would say probably 99%, maybe 98, 99% of them are just regular rentals. I have very few clients who are actually doing, Airbnb hotel type services, but something to keep in mind.
Awesome. All right. So we've been making everyone wait for, 30 minutes or so, tons of great information. So we're going to do a little giveaway. We got multiple sets of Amanda's book. Shoot a email to giveaway@fibrei.com. That's giveaway@fibrei.com. And we'll do a drawing. We'll let it run for 3 days, and then we'll do a drawing and get about several sets of Amanda's books. If you don't win, you should at least buy them. We'll drop a link in the show notes for you. There's really, really great information in there. We got both sets of the books. So Amanda, if someone gets the book, whether they get the giveaway or they buy a copy of the book, they love it. They said, oh my goodness, Amanda's amazing, and they want to work with you. Well, do you guys actually take on any other clients right now?
Yeah, we do. So we, our passion, we have a passion in simplifying taxes, right? Because again, I think that people are, a lot of people are so afraid of taxes, and our passion, as you can see in reading the book, we really try to simplify the strategies and the action steps that need to be done to receive the benefit. So we have a program, our strategic tax savings program, and it's designed to do just that. We take out all the fluff, we take out all the tax codes and how do you depreciate stuff, because as an investor, you don't really care. You don't really need to know how to
I just want to know if you're going to save me money, right?
Yeah. I mean, you just need to know, like, well, Amanda, what do you want me to do? What do you want me to give you? Right. And that's exactly, and I love how you started our podcast today with that. Earlier on, you said, okay, what do I need to do? What do I need to give you? And that's essentially why we developed the program. Is people have said, oh, there's so many things about taxes, I don't even know where to start. And so it's kind of the first step is just, okay, what is it? What is the benefit, and what do you need to do to plan ahead? So yeah, we're always looking to help investors across the U.S. and figure out ways that they could take simple steps to reduce their own tax liability. And we try to set up the program so that you can, regardless of who you work with, whether it's us or another CPA local to you, that you are giving them the right information in the right format so that they can best help you to, reduce your taxes overall.
Awesome. Well, Amanda, thank you for being on the show. But before we let you go, we like to ask all of our guests a set of final 6 questions. Are you ready for them?
I think so.
Awesome.
I'm always so nervous for.
Don't worry. They're not that hard. We're not going to stump you. All right. So question 1, what is your favorite personal finance related blog, book, or podcast?
There's so many. I love personal finance. One of my favorites is the 4-Hour Work Week. And it's not really necessarily real estate related, but I do apply that to my real estate business as well as my CPA business. Again, we talked earlier about like systematize, outsource, just kind of having the highest and best use of your time. So yeah, that's one of my favorite books.
Awesome. I love Tim Ferriss's stuff. All right. So question number 2, what's your favorite real estate related blog, book, or podcast?
Real estate related blog. This is, or podcast actually, besides yours, of course.
Thank you.
This is a newer one that came out. I think it's called the Data Driven Real Estate. I listened to a couple episodes, and I'm also a big data person, of course, being a tax person. I love data, and they talk a lot about how to use data to look at different marketplaces. They have some interesting speakers and influencers in just kind of real estate as a whole. And I really liked when they did recently on technology and how technology is going to impact real estate from an investor's perspective. So that's one of my new favorites I'm listening to.
I'm going to have to check that out because I really feel like real estate is both an art and a science. And if you use the data and look at market data, job growth, look at all of those things, comps, it's all very data driven, but you can buy a property, right? But then you need the art side of it, like the paint colors, the fixtures, the furnishings, all of that stuff. So I'm definitely going to check that one out. All right. So question number 3, what's been your favorite travel destination so far?
My favorite travel destination is Alaska. I went there when I was in college for the first time with my grandma and my aunts and uncles, and I just fell in love with the place. Before that, I was never a nature person, but I just find it to be so beautiful and calming at the same time. So whenever I have the chance, I usually try to go there for vacation if I can make my husband go with me.
Awesome. And then next up is what's on your travel vacation list sort of post-COVID?
Post-COVID, this is such a sad point. So we try to do, for our firm, Keystone CPA, we try to do a kind of a group vacation with all of our team members every year. And we had scheduled a cruise to go to Mexico in November, but
I'm guessing that's not happening.
Very likely not happening, but I think my next trip will probably be that because we promised people we were going. So we have a credit, and I think that'll be the next one, and hopefully it'll be soon before next March, which is our busy season again. We'll
I know if you don't sort of get it in there like mid-January, it doesn't happen till.
Yeah, then we're talking about next year end.
Yeah. All right. So question number 5, what's the biggest bucket list item on your list that you have not accomplished yet?
Bucket list item. Oh my gosh. I have so many, so many bucket list items. One thing that's recently been on my mind in terms of bucket list is I have a client who was able, before COVID, of course, able to take her younger kids and just, her family to live in a different country for a month, and to really be immersed in the culture. And she said it was so different than when you travel, when you just go to different hotels and stuff. So I think that's a bucket list thing of mine. Again, after COVID, I would love to be able to, take it like an immersion vacation, I guess. I just made up that term, but to really just be in a different country and experience that from a local's perspective.
There's a big difference between, like you said, that hotel, changing every couple of days versus this slow travel of just stay in a place for, a couple weeks, a month or two. You start to find your local favorite coffee shop and learn, get away from the tourist destinations and really understand a culture. Yeah, it's great stuff. I definitely recommend trying to do that one. All right. Sixth and final question is, what is your favorite life hack?
My favorite, I'm always looking for life hacks, always, every day I'm looking. My favorite one recently is I just bought myself a Roomba. I think that's called Roomba. It's, I think you know what I'm talking about.
Yeah.
And so it's one that it's a vacuum robot. It vacuums and mops your floor.
Oh, you
So I
got
don't
the
know
one
if
with the mopping too?
yeah, with the
Oh,
mopping, you see my floors. I mean, you can't see it there, but it's so nice, and I don't have to do that part of it anymore. So I'm really, that's what I'm loving right now. And I have two young kids, so I have, crackers and all kinds of stuff everywhere on the floor. And now my Roomba takes care of it. And I mean, it's kind of crazy, but I talk to my Roomba. I'll say good morning to it sometimes because, she works when we're sleeping. So I
yeah.
make sure she's well taken care of.
Yeah, no. Well, we named ours too. Ours is called Trogs. Sort of like a hog will come around and eat up any junk. So
Yeah.
I don't know how we came up with the name, but yeah,
Oh, I
as soon as
love
we had
that.
two Boston Terriers, it's just hair everywhere, and then Trogs comes around and runs and makes the house nice and clean. So,
Oh, I
um,
love that. I love that. Yeah, mine is named Dio. My son named him after like a Star Wars character, I
oh
believe.
yeah,
So
cool. Amanda, this has been so awesome having you on. Thank you so much for sharing all of this great information with us. If folks want to check you out or look into your strategic tax savings program, where's the best place for them to find you?
our website is the best place to go. That's www.keystonecpa.com, KEYSTONECPA.com. And yeah, so that we try to put the latest and greatest information on there. You'll find we also have a free downloadable ebook and CDs that, if this was not enough tax information for today, you can always get more on our website.
Awesome. And if you're driving or you're working out or something, we're going to link to her website in the show notes. So whenever you get to a place where you want to go follow up, just check out the show notes and we'll have her website on there for you. Well, Amanda, thank you so much for being on the show today. This was great. So much valuable information. And I really appreciate you taking the time to be with us.
Thank you. So happy to be here.